and welcome to the Hilltop Wealth Advisors Economic and Market Update for the third quarter of 2021. I'm Brittany Malika, here today with Chris Hostetler, and it is hard to believe we're already over halfway through 2021, but we certainly have a lot to talk about. So shall we get into it?
Let's do. I want to open with a thought from a show I love, Ted Lasso, with a line that I love, that all people are different people. It's the same with economic cycles. All recoveries are different recoveries. So we're in constant learning mode at Hilltop. And here's what we see in the ongoing recovery of 2021. Economic growth has been higher this year, but it's complicated right now, and it's hard to feel cheery about a pretty high GDP growth rate of more than 6% in the US. In these quarterly market updates we've had the pandemic and fiscal stimulus as major themes for over a year now, and we can't quite get away from those themes just yet. So we're watching, of course, the rollout of the vaccine. At this point, over half of our country has had at least one dose of the vaccination. And with the Delta variant arriving and causing case numbers to go up, it also seems to have triggered a new wave of vaccinations, which offers promise economically speaking, because it gets us closer to a more open reopening. What we've seen economically in the US in 2021 is that equity markets have rallied, home prices have surged, and sectors in the economy that were previously adversely affected by the pandemic have started to show solid improvement as we get closer to the new normal, whatever that is.
And what's really notable about the past year and a half is the record-breaking fiscal and monetary policy that we've seen, both in terms of the size, but also the speed in which it was all rolled out. The Federal Reserve, of course, cut interest rates to 0% back in March of last year, and mid-2020 began their asset purchase program, quantitative easing, both of which still going on today. And the federal government rolled out trillions of dollars in fiscal stimulus. And this has really helped businesses and consumers be in a stronger financial position with a lot more cash.
That's right. And so far we've talked about the US, but even globally, we've witnessed a transition from economic recovery to economic expansion. And you can see in this chart that it's been a pretty sharp V-shaped recovery. In fact, the sharpest in modern history. Things have turned around for the better pretty quickly following the second quarter of 2020, when, of course, we were all adjusting to lockdown mode and what it looked like dealing with the pandemic. Now, this chart looks smooth, but that belies the variations that we see in the pace of recovery across the globe, largely depending on each country's access to vaccines. So that's something that we're aware of, both from the human impact of it, but also from the economic and financial impact of it. Now, speaking of financial impacts, the big topic du jour is inflation, and that's something we definitely need to talk about for a minute. We've seen a pretty significant increase in prices year to date, and we think that's coming from a confluence of three pretty classic causes of inflation. Number one is rising demand. Number two is supply chain issues, which is leading to limited supply. And number three is that there's just more money in circulation. And we'll talk, I think, about stimulus and quantitative easing in a few minutes. But all three of these factors were spurred by COVID. We believe eventually these factors will recede and inflation will recede as the pandemic does. Now, also related to inflation, we saw bond prices drop through the first half of 2021. This is also referred to as yields rising, but this was largely because of inflation concerns. Now, more recently, over the last couple of months or so, we're seeing bond prices rising again, and that's possibly because investors believe that we've seen the peak in economic growth and maybe even the peak in inflation, and that it's time to get defensive again. We are also seeing labor demand surging, meaning that there is just more demand for workers, and that has a positive impact on the unemployment rate, which of course got pretty high during the pandemic, but it has dropped more recently, and it has hovered steadily around 6% for several months now. It's also important to note that part of this story is that there don't appear to be as many workers available. And of course, they're not counted in the unemployment number if they're not looking for work. Number of reasons for this. Of course, unemployment benefits have been extended and currently are still at enhanced levels. Also, a lot of workers have lingering pandemic worries and childcare responsibilities, and there are some workers that simply are not able to look for work right now. There have also been a high number of early retirements, so some people have left the workforce probably for good. So, Brittany, that's where we think we are right now. What do we think we can expect looking forward?
Yeah, we think the big question really is, what is this economic recovery and expansion going to look like? Is it going to be a long, strong expansion, or more of a slow and steady one? Or are we going to see a short recovery followed by another downturn in the near future? And of course, we can't say for sure, but we do feel optimistic about the trajectory of the economy at this point. And there are several positive factors playing into this. For one, the pandemic really accelerated productivity trends in a lot of industries and businesses. Just think about the e-commerce and telecommuting. So many businesses found better, more efficient, cost-effective ways to do business. Maybe more importantly, though, this recession was not caused by financial reasons. Global pandemic, not a financial trigger. Because of that, and also because of all the fiscal stimulus that we've seen, businesses have a lot more cash and are in a much stronger, healthier position than one might expect. Same with consumers. Consumers, for the most part, have built up savings from the past year and are ready to get back out there and spend. And this pent-up demand and eagerness to return to spending like normal is not what you would traditionally see after a more normal recession.
That's right. And there's another big trigger for potential growth going forward in this infrastructure package that's currently winding its way through the Senate. And of course, politics. So who knows where this thing is going to end up. But as of this moment, it looks like it will cause government spending of about $1 trillion, which then pushes that money into the hands of businesses and consumers eventually.
Exactly. So really long term, we do expect continued GDP growth, although likely at a lower rate than what we've seen over the past year.
That's right, at a lower rate and also at a very choppy rate. We don't think the recovery is likely to be smooth. Of course, economic growth never goes in a straight line. And right now, just like always, we're monitoring a number of risks. Some of the key and specific risks that we're looking at right now, of course, pandemic related virus variants, number one. Right now, we're seeing the Delta variant cause dramatically rising numbers of cases in the US, and that could slow things down. There's also a related risk that antibodies from the vaccine begin to wane as we reach the fall and winter, and maybe we need booster shots. Maybe that causes rising case numbers and another retrenching. There's also a parallel between COVID and the economy, and that things can change very quickly. For the good or for the bad. 5 to 6 weeks ago, of course, the COVID situation appeared to be mild and improving in the US. Now it's substantially more concerning as we film this in early August. But a second risk, moving on from the pandemic, a second risk is that we continue to see higher inflation. And a third and related risk is that there is ultimately pressure on the Fed to tighten monetary policy, particularly if inflation worsens. So Brittany, maybe you can talk about the portfolio implications of all of this.
Definitely. Yes, there's clearly a number of factors that we're considering as we're thinking about our portfolio management. In the fixed income space, in particular, with this backdrop of higher inflation and most likely continued economic growth, plus knowing that the Federal Reserve will eventually switch from their really accommodative stance, we do expect to see bond yields rise. That means that bond prices will eventually start to fall. Now, given that we're more favorable towards fixed income with a lower duration, But at the same time, the economy is quite strong and businesses are quite healthy. So we also think there could be income opportunities in the lower credit quality space. On the flip side, thinking about equities, we're pretty optimistic as a whole, but in particular, there could be opportunities in cyclical businesses and industries. And that means those are businesses that are more discretionary. So when the economy is doing well, their products, goods, services tend to be in higher demand. And when the economy is not doing as well, these businesses tend to suffer more. So think travel, tourism, that's a good example of a cyclical industry. There definitely could be opportunity there. We also feel favorable towards international equity as well, since so many countries are reopening at different times and paces. Europe in particular is behind the US, so there could be an opportunity to take advantage of their return to normal.
Yeah, and in addition to the equities and fixed income allocations that are kind of the meat and potatoes of our portfolio, we always work in a specialty allocation. Right now, a good significant portion of that specialty allocation is an overweight in energy. And in our socially responsible portfolios, we're using clean energy. That holding has done well. We bought that because we saw a pricing opportunity in the early days of the pandemic. Now we're holding it largely as an inflation hedge. But overall, our strategy remains as it has been, right, Brittany? We want to stay diversified. We need to keep an eye on these market dislocations for opportunities to rebalance the portfolio. And we're really not looking to make any large or risky bets.
Well said. Well, thank you, Chris, and thank you all so much for watching. We hope you enjoyed this and learned something, and we're so grateful that we've been able to continue to work with all of you virtually over the past year and a half. And if you aren't working with Hilltop yet, know that we're always happy to talk with you, and you can visit our website or the Hilltop Views blog to learn more about us. Thank you.